what we're witnessing is really the fact that if a market trades from $1 to $2 and then corrects or sells off to $1.50, it still took 2 steps forward and only 1 step back. In other words, when we watch a market, unless it's parabolic, it does move up in a stair-step manner, meaning it has a surge in price, it gives back some, it goes into another rally or wave, so another surge, and then it gives back less. As long as it gives back less than it accumulated on the way up, it's still considered to be have bullish market sentiment.
Earlier this week, gold experienced a dramatic rally, skyrocketing to an impressive high of over $2,480 per ounce. This was a significant jump from its recent low of $2,300, marking a substantial $188 increase. This surge sparked excitement among traders, hinting at the potential for further gains as it approached the psychologically significant $2,500 level. Technical analyst Gary Wagner notes that the recent surge in gold prices, peaking above $2,480 per ounce, has left many traders and investors on edge. They wonder if the bullish momentum can be sustained or if a more significant pullback is imminent. According to Fibonacci retracement analysis, a 50% retracement of the recent upward move from $2,300 to $2,488 would position gold around the critical support level of $2,400. This midpoint is significant because it is often a psychological barrier where traders reassess their positions. Gold is hovering near $2,410, just above this crucial level, making it a focal point for market sentiment. Will this $2,400 level hold against selling pressure? Historically, the 50% retracement level is seen as a strong support point where prices tend to stabilize before making their next move. If gold can maintain this level, it could signal a consolidation phase, giving the market a breather before potentially resuming its upward trend. However, if selling pressure intensifies and the $2,400 support fails to hold, the next area of interest would be the 50-day moving average, which currently stands at approximately $2,375. This moving average is a dynamic support level closely watched by technical analysts like Gary. The 61.8% retracement is another critical level in Fibonacci analysis, often called the golden ratio, and is closely monitored for potential reversals or continuation of trends. Should gold prices decline to this level, it would represent a more substantial correction from the recent highs, potentially shaking out weaker hands and providing a solid foundation for future gains. We will present clips from Gary Wagner's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
We're looking at the compression triangle that we talked about last time we were on, which is created simply from a series of lower highs and equal bottoms. A flat bottom, you've got equal lows, but descending top, and that is because you've had a series of lower highs. And so what happened is we saw that there was a real possibility last time we talked that if gold broke through this upper level resistance line created as a trend line from the lower highs, then we could get a sizable breakout to the upside. And the way I like to explain it is it's kind of like tightening a spring. Every time gold trades to a top and then moves back to the bottom, it kind of tightens that spring up. Then it goes to the top, but doesn't break through. It tightens it a little bit more, tightens it on this last one. And so when it does break through the resistance line, it can do it with an extreme amount of power. In this case, it was kind of a tepid move. It moved for 2 days and then moved sideways. What we are witnessing now was when you consider that the low that came in on this compression triangle or descending top flat bottom was from 2,300 to 2,488. So we're talking about a move of roughly $188. That's a respectable rally for gold. That coupled with the fact that it hit a very strong, even psychological number, 2,500. It found resistance there. And the absolute top of the market occurred a couple of days ago, but that was also the day that gold futures traded to the highest intraday value in history, which is 2488. So what we witnessed through the week has been, I believe, profit taking, and it is a correction. So the question is, will this be a shallow or deep correction? Because what you see in blue to the right of these lines are based on a Fibonacci retracement or a retracement set. So we start at 2308, we go up to 2488, and a 50% retracement. In other words, if it gave back 50% of the rise, that would have taken it to about 2400. And that's kind of where we're at, because we're at 2401. So the question is, will it find support at this level? If not, it most likely will trade lower to the 50-day simple moving average, which also corresponds to the 61.8% fib retracement at approximately 2375. A market trades from $1 to $2 and then corrects or sells off to $1.50. It still took 2 steps forward and only 1 step back. In other words, when we watch a market, unless it's parabolic, it does move up in a stair-step manner, meaning it has a surge in price, it gives back some, it goes into another rally or wave, so another surge, and then it gives back less. As long as it gives back less than it accumulated on the way up, it's still considered to be have bullish market sentiment.
In September 2021, the U.S. Federal Reserve shifted its stance on inflation from cautious to concerned after 3 consecutive months of inflation rates exceeding its 2% target. This period of elevated inflation, highlighted by the Personal Consumption Expenditures Price Index surging above 4% from May to July, prompted a notable change in the Fed's rhetoric. Despite inflation easing to 2.6% later, the Fed has retained the term elevated in its policy statements. However, expectations are high that the upcoming Fed meeting may finally retire this term, signaling a potential move towards interest rate cuts starting in September. This shift in monetary policy strategy reflects the Fed's proactive stance in maintaining economic stability, a move closely monitored by investors across various asset classes, including commodities like gold. Federal Reserve Chair Jerome Powell's indication that rate adjustments could proceed reaching the 2% inflation goal marked a pivotal moment in Fed communication. It underscored a desire to act decisively to support the economy, resonating strongly in financial markets. Powell's remarks had an evident impact on the gold market, where prices surged to an all-time high above $2,500 per ounce. However, as is often the case after reaching new highs, profit-taking activities ensued, leading to subsequent price retracements.
When we look back to what occurred on Monday, that really was that last feather in the cap of the rally. Powell came out talking at the Economic Club of Washington. And when asked about a September rate cut, in fact, any Fed member, when asked about the timing of a rate cut, would simply push that off. Powell's language was that we're focusing on getting inflation down to a 2% target. We're not there yet, and we need greater confidence, always put in quotation marks, and that greater confidence comes from more data, which simply means more reports lending evidence to the fact that inflation continues to tick down. Now, prior to him speaking, the last inflation report that came out showed a consistent trend of 3 months, consecutive 3 months with lower inflation prints. And so for the first time when asked about a September rate cut, he said, I'm not going to address the timing, but we will cut rates before they hit the 2%, before inflation hits its 2% target. And so in Powell speak, in Fed speak, that's a clear indication that they most likely they're planning on initiating the first rate cut since they started raising rates in March of 2022 and beginning a process of interest rate normalization. In other words, it's the first rate cut is exceedingly important, but then we have to go back to the dot plot. The most recent one is in June, and the most recent dot plot, which takes the 19 members that are at the meeting and has them vote on the likelihood of where inflation will go, where interest rates will be, and what the GDP or the economy is. And in March, they were anticipating that they would cut rates 3 times by 0.25%. In June, they revised that to 2 times by 0.25%. So the fact that he opened the door to a September rate cut is really what created the last moves in gold, and it found resistance at 2,500. Anytime any stock or commodity goes to an all-time record high, it typically meets resistance, backs off, even if it's still in a bullish momentum. And that's what we're seeing with gold.
Gold is set to maintain its bullish momentum above the crucial support level of $2,403.30. The immediate resistance is $2,411.87, while key support is $2,393.71. Expectations of a potential Federal Reserve rate cut and ongoing geopolitical tensions are likely to bolster gold's status as a safe haven asset, further supporting its upward trajectory. Share your thoughts on Gary's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.